Welcome to our deep dive into the world of Forex trading.
Yeah.
We've got some really insightful excerpts from Anna Couling's book, A Complete Forex Trading Library, and we're going to unpack them.
Yeah.
We're going to go beyond the surface, really get into like the mechanics of how the Forex market works,
Absolutely.
and hopefully give you guys some aha moments along the way.
Yeah.
One of the things that immediately grabbed my attention was Couling's emphasis on volume price analysis, or she calls it VPA. Now, she's not talking about some fancy new indicator here. This is stuff that's been around for over a century. Guys like Charles Dow, Jesse Livermore, they built their fortunes using this stuff.
Yeah, and what's interesting is they were working with just ticker tape, pencil, and paper.
Wow.
And they understood that by combining the price movements with trading volume, they could really see the true intentions of the market, something that most traders today are missing.
Okay, so help me understand this. It's not just about predicting which way the market's going. It's about something more.
Exactly. VPA helps you spot those fake outs, those price movements that look really promising, but lack the volume to support a genuine move. Think of it this way. Price is what the market says. Volume is what the market does.
Oh, okay.
You can use VPA on today's charts. It's the same thing that Jesse Livermore was doing with that ticker tape. Spot those subtle volume clues that reveal the market's true intentions.
Wow, I never thought of it that way. So how do we actually put this into practice? How do we use VPA?
Well, Coulling provides a really clear three-step process.
Okay.
First, you examine individual candlesticks on a price chart, paying attention to the price spread and the corresponding volume. This gives you insight into the forces at play within that specific time frame.
So it's like we're taking a magnifying glass to each candlestick and really trying to decipher the story it's telling us.
Precisely.
Okay.
Step 2 involves zooming out, analyzing clusters of candlesticks surrounding the most recent one, looking for emerging patterns and changes in sentiment. And finally, you consider the entire price chart to get the big picture, the overall trend and context for the price action.
So we start with the detail and then kind of expand our view to see how those details fit into the larger story.
Yeah?
It's like those Russian nesting dolls.
And that's a great analogy.
Okay.
Now, as you master these steps, you start to recognize the tactics of market manipulation, something Coulling argues is more prevalent than many realize. And it's not necessarily about controlling prices directly. It's about manipulating trader psychology, fear, and greed.
So you're saying that there are forces out there that are actively trying to influence our trading decisions.
Yeah, and they'll often use the media to spread fear or hype. Imagine a scenario where news headlines are screaming about a currency's collapse, triggering panic selling. VPA can help you see if the volume actually confirms this fear or if it's a manipulation trap designed to shake you out of your position.
That's a bit unsettling.
It is.
But also empowering to know that we can potentially see through those manipulations.
Yes, definitely.
Okay, so it's not enough to just analyze individual currency pairs, right? Coulling talks about this thing called relational analysis, right?
Right. To really understand Forex, you need to connect the dots between different asset classes. This includes things like bond yields, currency correlations, and the US dollar index.
I've always been a bit intimidated by bond yields. They just seem so complex. How do they play into this? How do they play into the Forex market?
Well, think of it this way. Relational analysis is about connecting the dots between different markets. When investors get nervous, risk-averse, they often flock to bonds as a safe haven. This drives bond prices up and yields down. Conversely, when risk appetite is high, money flows out of bonds and into riskier assets, pushing yields up.
Okay.
So by watching bond yields, you can get a sense of the overall market mood, which can then inform your Forex trading decisions.
So bond yields are like a barometer for risk sentiment.
Exactly.
Okay. That's a really valuable insight. What about currency correlations? I know some currencies are linked to specific commodities or economic sectors.
Absolutely. The Australian dollar, or AUD, is strongly correlated with commodity prices because Australia's economy is heavily reliant on resource exports. Understanding these correlations can help you anticipate how currencies might react to events in those specific sectors.
So if there is a sudden surge in oil prices, we might expect to see the Canadian dollar strengthen, given their oil-rich economy.
Exactly. It's all about understanding the interconnectedness of global markets. And then there's the US dollar index, which tracks the value of the US dollar against a basket of other major currencies. This index is essential for understanding dollar strength or weakness, which can have a ripple effect across various Forex pairs.
Okay, so it's like having a pulse on the US dollar's health.
Exactly.
This is all making so much more sense now. So we've covered VPA, we've covered relational analysis, and Culling also dives into the role of central banks in Forex, right?
Yes, and this is where things get really interesting.
Okay.
In recent years, central banks have become increasingly active in the Forex market, intervening to manipulate exchange rates to their advantage.
It's almost like a currency war out there.
That's exactly what Coulling calls it.
Wow.
They use various tools to influence their currencies, like manipulating interest rates to attract or deter foreign investment, or by directly intervening in the market, buying or selling their own currency.
So central bank actions can create these distortions in the Forex market, making it even harder to trade based purely on traditional economic fundamentals.
Exactly. They add another layer of complexity that traders need to be aware of.
Wow.
And, even with all this complexity, choosing the right broker is absolutely crucial for success in Forex.
Okay, so let's talk about brokers. What are the key things that we should consider when selecting a broker?
There are a few crucial factors.
Okay.
First, you need to decide between a dealing desk broker and a no-dealing desk broker.
Okay.
Dueling desk brokers act as intermediaries in your trades, which can potentially lead to conflicts of interest.
So they might be working against my best interests.
That's a valid concern. On the other hand, no-dealing desk brokers send your orders straight to the interbank market, providing greater transparency and potentially fairer pricing.
Okay, so that's thinking a better option then.
It often is. But it's important to weigh the pros and cons based on your trading style and risk tolerance. You also need to carefully consider fees and commissions. Brokers use different fee structures, like spreads, commissions, and rollover fees, which can all impact your profitability.
So it's like shopping for the best deal, except in this case, it's about finding the broker that aligns with my trading strategy and my budget.
Exactly.
Okay.
And finally, and critically, you need to make sure your broker is properly regulated to protect your funds.
Yeah, regulation offers that level of security and accountability that's essential in this world of Forex trading. I don't want to end up with a shady broker that disappears with my money.
Absolutely not. Regulation is crucial for peace of mind in this market.
Okay, so we've covered a lot of ground in this first part of our deep dive. We've explored VPA, relational analysis, central bank manipulation, and even broker selection.
And we've only just scratched the surface of what Coulling covers in her book.
I know, this has been incredibly insightful already. I feel like I'm starting to see the Forex market in a whole new light, but there's still so much more to explore.
There is. Coulling goes into much greater depth, but this gives you a really solid foundation for understanding the intricacies of Forex trading. It's a complex landscape, but I think you're ready to navigate it with a little more confidence now.
Before we wrap up this first part of our deep dive, I have one final thought-provoking question for our listeners. If the Forex market is no longer driven solely by those traditional economic fundamentals, how can you adapt your trading strategies to account for these new realities? Keep that in mind as we move on to part 2 of our Forex deep dive, where we'll go even deeper into these fascinating concepts.
Looking forward to it.
See you there.
See ya. Welcome back to our deep dive into the Forex market. Hopefully you had some time to digest all that information from part 1, because we're about to explore some specific examples.
You know I love a good challenge, especially when it comes to unraveling these market mysteries.
Absolutely.
So where are we headed next in our Forex journey?
Let's talk about central banks.
Ooh, central bank.
Remember how we discussed their increasing intervention in the Forex market?
Yeah.
Coulling dedicates a significant portion of her book to understanding the motives and actions of these financial powerhouses.
Okay.
And provides some really compelling examples.
I'm all ears. Central bank intervention, it always seemed like this shadowy force influencing markets behind the scenes. It's fascinating how they can essentially print money and use it to influence these exchange rates.
It's a powerful tool, and one that has become increasingly common in recent years. For example, Japan's central bank, the Bank of Japan, or BOJ, has a long history of intervening in the market, especially when it comes to weakening their currency, the yen.
I remember reading about Japan's lost decade, this period of economic stagnation. Did central bank policy play a role in that?
It certainly did. Following a massive asset bubble in the 1980s, Japan's economy kind of took a nosedive. The BOJ tried to stimulate growth by slashing interest rates to near zero and injecting trillions of yen into the system.
Wow.
But these efforts had limited success, and the economy remained sluggish for years.
So even with all that intervention, they couldn't fully control those economic forces at play.
It's a cautionary tale about the limits of central bank power. Despite their best efforts, they can't always achieve those desired outcomes. And this brings us to an important point. Central banks are not all powerful. They operate within a political environment and often face pressure from governments and special interest groups.
That makes sense. So it's not always about making these purely economic decisions. Politics can play a role.
Exactly. Central banks sometimes have to balance economic goals with political realities, which can lead to unpredictable actions in the Forex market. Now let's shift our focus to the Australian dollar, the AUD, a currency that is very closely tied to commodity prices.
I remember that from our discussion on currency correlations. Australia is a major commodity exporter, so their currency is really sensitive to those changes.
Precisely. And the Reserve Bank of Australia, or RBA, has a unique perspective on managing their currency. They understand that a strong AUD can actually hurt their export competitiveness, making their goods more expensive for buyers in other countries.
Okay.
So they often intervene to prevent the AUD from appreciating too much.
It's almost like they're fighting against their own currency's strength. Why would they do that?
They have to strike a balance. A strong AUD has benefits, like lower import costs, but it can also negatively impact their export sector, making Australian goods less competitive globally.
Makes sense. So they're walking a tightrope.
It's a constant balancing act for the RBA.
Okay, so we've looked at central bank intervention in developed economies like Japan and Australia. What about emerging markets?
Coulling doesn't shy away from exploring those dynamics either. She delves into currencies like the Mexican peso and the Brazilian real, both of which can be influenced by factors beyond those traditional economic indicators.
I'm curious about those currencies. They're definitely not as widely traded as, say, the euro or the US dollar. What makes them interesting from a Forex perspective?
Well, both Mexico and Brazil are major oil producers and exporters, so their currencies are often sensitive to fluctuations in oil prices. But there's more to their stories than just oil. Mexico, for example, has actually seen its oil production decline in recent years.
Oh, wow.
Which has put pressure on the peso.
So even though they're oil producers, if that production falls short, their currency can actually weaken.
That's right. It highlights how a single factor like oil production can have a really significant impact on a currency's value. And Brazil, they've been grappling with high inflation, which has forced its central bank to raise interest rates to try to combat those rising prices.
I remember that higher interest rates can attract foreign investment, which can then strengthen a currency. But those higher rates can also slow economic growth, right?
Exactly. It's a very delicate balancing act for Brazil's central bank to control inflation without stifling economic growth. And their actions can create a lot of volatility in the Brazilian real.
It seems like emerging market currencies can be particularly susceptible to these kinds of economic and political shocks.
They often are. And Coulling really emphasizes the importance of understanding these broader contexts when trading emerging market currencies. Now let's venture to Africa and explore the Nigerian Naira. This currency has faced significant devaluation pressures in recent years.
That sounds concerning. What has contributed to his weakness?
Well, Nigeria is a major oil exporter, but they face issues with corruption and political instability.
Okay.
These factors have really eroded investor confidence, leading to capital flight and downward pressure on the Naira.
So it's a reminder that economic fundamentals are not the only drivers of these currency movements. Political and social factors play a huge role.
Absolutely. Coulling highlights this point throughout her book. Understanding the political and social landscape of a country is crucial for making informed Forex trading decisions, especially in emerging markets. Now let's journey to Egypt.
Okay.
And examine the Egyptian pound.
Okay.
This currency has also experienced periods of weakness driven by factors beyond traditional economic data.
I've heard that Egypt relies heavily on tourism. Has that impacted their currency?
Definitely. Tourism is a major source of foreign currency for Egypt.
Right.
However, political instability and social unrest have really negatively affected their tourism industry, leading to a decline in those foreign currency inflows and downward pressure on the pound.
So again, we see how those events outside of those traditional economic indicators can really influence a currency's value.
Exactly. The Forex market is this complex interplay of economic, political, and social factors.
Yeah.
No single indicator or analysis technique can provide a complete picture.
Okay.
That's why Coulling really advocates for a holistic approach to Forex trading.
What does she mean by a holistic approach? Does she mean going beyond just the technical indicators, the charts?
Precisely. She encourages traders to combine their technical analysis with fundamental analysis and an awareness of geopolitical events. It's about piecing together the puzzle, considering multiple perspectives to make truly informed trading decisions.
That makes sense. It's like being a financial detective, gathering clues from all these various sources to solve the Forex mystery.
That's a great analogy. Now, Coulling also sheds light on the importance of understanding the unique characteristics of different currency pairs. She dives into popular pairs like the Euro-US dollar, the British pound-Japanese yen, and the Australian dollar-US dollar, highlighting their individual nuances and behaviors.
Okay, so those are some of the most commonly traded pairs. What kind of insights does she offer about their behavior?
Well, the Euro-US dollar pair, for example, is often seen as a reflection of the relative economic strength of the Eurozone and the United States. When the Eurozone economy is performing well, economic data releases are positive, the euro tends to strengthen against the US dollar.
So it's a gauge of economic performance between these two major economic blocks.
Exactly. And the British pound-Japanese yen pair is often viewed as a barometer of risk appetite.
Okay.
When investors are feeling confident and optimistic about global growth, they tend to buy the pound, which is seen as a riskier currency, and sell the yen, which is considered a safe haven currency.
Yeah, okay. So this pair can be particularly volatile during periods of market uncertainty. If investors are fearful, they flock to the yen, driving up its value against the pound.
Absolutely. Understanding these dynamics is crucial for trading this pair effectively. And then the Australian dollar-US dollar pair, as we discussed earlier, heavily influenced by commodity prices, particularly metals and energy.
Okay.
So this pair can be particularly sensitive to changes in global demand for those raw materials.
So it's a pair that requires traders to keep a close eye on those commodity markets and how those prices are fluctuating.
Precisely. Now, Coulling also explores the concept of cross-currency pairs, which involve currencies other than the US dollar.
I've heard of those, but I'm not as familiar with them. What makes them different from those major pairs we've been discussing?
Well, cross-currency pairs can be less liquid than the major pairs. That means there might be fewer buyers and sellers at any given time, which can result in wider spreads.
Wider spreads. Can you remind me what spreads are again?
Of course. The spread is the difference between the buy and sell price for a currency pair.
Right.
Wider spreads mean that it can be more expensive to enter and exit trades.
So it's important to factor in those wider spreads when trading these cross-currency pairs. It could eat into my profits.
Exactly. Coulling emphasizes that while cross-currency pairs can offer unique trading opportunities, they also come with those additional risks due to their lower liquidity.
Got it.
Now, let's delve into the world of exotic currencies.
Okay, exotic currencies.
These are currencies from emerging markets that are often less traded and more volatile than those majors.
Exotic currencies, it sounds a bit mysterious. What are some examples?
Well, some examples include the South African rand, the Turkish lira, the Mexican peso.
Those are definitely not your typical Forex pairs. What makes them unique?
Exotic currencies can be very attractive to traders seeking those higher potential returns due to their volatility.
Okay.
However, they also come with significant risks that traders need to be aware of.
So it's important to approach them with caution.
Absolutely.
Yeah.
Exotic currencies can be influenced by factors like political instability, economic sanctions, and commodity price fluctuations, which can make them highly unpredictable and challenging to trade.
It sounds like trading exotic currencies is a bit like venturing into the Wild West of Forex trading. High risk, high reward.
In a way, yes. But with careful research and a robust risk management plan, exotic currencies can offer intriguing trading possibilities for those willing to take on that added risk. Now, Coulling doesn't just focus on currencies and central banks in her book. She also provides valuable insights into technical analysis and trading strategies, offering those practical tools for navigating the Forex market.
Ooh, okay. This is where things get really interesting for me. The practical application of all this knowledge. What kind of technical analysis techniques does she discuss?
She covers a wide range of technical indicators and chart patterns that traders use to identify those potential entry and exit points for their trades. She discusses concepts like moving averages, support and resistance levels, and candlestick patterns, which are all visual representations of price action that can help traders identify trends and potential trading opportunities.
Okay, those sound familiar. I've heard of those indicators before, but could always use a refresher. Are those the main tools in a technical trader's arsenal?
They are some of the most commonly used tools, and Coulling explains them in detail. But she emphasizes that technical analysis is not about predicting the future with certainty. It's about identifying probabilities based on historical price data
Yeah.
and managing risk effectively.
So it's not a crystal ball, but more like a roadmap that shows us the paths the market has taken before and where it might be headed.
That's a great way to put it.
Okay.
Technical analysis helps traders spot those potential trading opportunities based on historical patterns and trends.
Okay.
Coulling stresses the importance of combining technical analysis with fundamental analysis and an understanding of market sentiment to make well-rounded trading decisions.
So it's not just about looking at the charts in a vacuum. It's about understanding those broader economic and political factors that might be driving the market.
Precisely. Couling's approach to technical analysis is about finding confluence. That means identifying points where multiple indicators and market signals align
Okay.
to suggest a potential trading opportunity.
It's like piecing together a puzzle to find the most likely outcome based on all the available evidence.
Exactly. And she encourages traders to develop their own trading systems that fit their individual risk tolerance and trading style. There's no one-size-fits-all approach to Forex trading.
That makes sense.
What works for one trader might not work for another.
It's about finding the strategy that aligns with my personality and my comfort level with risk.
Exactly.
Now, before we wrap up this second part of our Forex deep dive, I have a question for our listeners to ponder. How can you use the insights we've discussed today about central bank intervention, currency correlations, and technical analysis to identify potential trading opportunities in the current Forex market? It's a lot to think about, but these are the types of questions that can really help you develop that deeper understanding of the Forex market and potentially improve your trading. Welcome back to the final part of our deep dive into the Forex market. We've covered a lot of ground, from the power of VPA to central bank intervention, all those different currency pairs.
Yeah.
But there's one crucial element we haven't tackled yet, and it's something that Coulling emphasizes throughout her book.
We're talking about risk management.
Exactly. It might not be the most exciting topic, but it's absolutely essential for anyone who wants to succeed in the Forex market.
Yes,
It's really the foundation upon which successful trading is built, and Coulling dedicates an entire chapter to it.
Right. And she's absolutely right to stress its importance. Even with the best trading strategy in the world, you can still lose money if you don't manage your risk effectively.
So let's break it down. What are the key principles of effective risk management in Forex trading? Where do we even begin?
Well, the first principle is understanding your own risk tolerance. This means knowing how much money you're comfortable risking on any given trade without letting emotions get in the way.
Okay, so it's about finding that balance between potential profit and potential loss, right? Knowing how much I can afford to lose without it keeping me up at night.
Exactly. You need to define your risk appetite before you even enter a trade.
Okay.
And then stick to it even when emotions are running high during a volatile market.
That's easier said than done.
Oh, absolutely.
The market can be so unpredictable, and it's easy to get caught up in the excitement of a trade and kind of forget about the potential downside.
That's why having a predefined risk management plan is absolutely crucial. It takes the emotion out of the equation and helps you make those rational decisions based on your predetermined risk tolerance.
Okay.
Think of it as a set of rules that you agree to follow no matter what happens in the market.
So once I know my risk tolerance, what's the next step? How do I translate that into actual trading decisions?
Well, the next step is to determine your position sizing. This means calculating how many lots you'll trade based on your account balance and the percentage of your account you're willing to risk on a single trade.
Okay, so I remember from our earlier discussion that a lot represents a standardized unit of currency in Forex.
Yes.
But how do I determine the right lot size for my trades given my risk tolerance? It seems like a pretty complex calculation.
There are a lot of formulas and calculators available online that can help you with this.
Okay.
But the key is to make sure your position size aligns with your predetermined risk management plan. If you've decided to risk 1% of your account on a trade, your lot size needs to reflect that.
So if I have a $10,000 account and I'm only willing to risk 1% on a trade, I'm essentially risking $100.
Right.
And then the lot size I choose needs to ensure that my potential loss on that trade doesn't exceed that $100.
That's exactly right. It's all about finding that balance between maximizing potential profit without overexposing yourself to risk. And this is where stop-loss orders come into play. They're essential for any effective risk management plan.
Okay, stop-loss orders. Remind me how those work again. It sounds like some kind of safety net.
They are. A stop-loss order is an order that automatically closes your trade when the price reaches a certain level that you predetermined.
Okay.
They protect you from catastrophic losses by limiting your downside on any given trade.
So if I'm buying a currency pair and I set a stop-loss order below my entry price, the trade will automatically close if the price drops to that level, limiting my potential losses.
Exactly. It's like an insurance policy for your trades. But the key is determining the right place to set your stop-loss order.
Okay.
You don't want it to be so tight that it gets triggered by just normal market fluctuations.
Right.
But you also don't want it to be so wide that it allows for really significant losses.
That makes sense. So where do we set these stop-loss orders? Is there a formula, a magic number?
There's no magic number, unfortunately. But this is where technical analysis comes in. You can use support and resistance levels, moving averages, or other indicators to identify those logical points to place your stop-loss order.
So it's about finding a level where the price action suggests that my initial trading thesis might be wrong.
Right.
And it's time to exit the trade.
Exactly. It's about cutting your losses short
Okay.
and preserving your capital for future trading opportunities.
Gotcha. Okay, so we've got risk tolerance, position sizing, and stop-loss orders. What else do we need to consider for effective risk management?
Well, Coulling also talks about the importance of having a well-defined trading plan,
Okay.
which is crucial for staying disciplined and consistent in your trading.
So it's more than just knowing how much to risk. It's about having a strategy, a set of rules to kind of guide my trading decision.
Precisely. A trading plan outlines your overall approach to the market, including your preferred trading style, whether you're a scalper, a day trader, or a swing trader, your risk management rules, including your risk tolerance, position sizing, and stop-loss strategy, your entry and exit criteria based on your technical or fundamental analysis, and your plan for handling both winning and losing trades.
Wow, okay.
It's important to have a strategy for both scenarios.
So it's like a comprehensive guide that covers every aspect of my trading. It sounds like a lot of work to put together.
It does require some effort up front, but it's an investment that will definitely pay off in the long run. And it's not a static document. You should review and refine your trading plan periodically as you gain experience and learn from your mistakes.
So it's a living document that kind of evolves with my trading journey.
Exactly.
Okay, that makes sense.
And speaking of learning from mistakes, Coulling also emphasizes the importance of keeping a trading journal.
A trading journal, what's that? Is that like a diary for my trades?
It is.
Yep.
A trading journal is a record of all your trades, including your entry and exit points, your position size, your profit or loss,
Okay.
and, importantly, your thoughts and emotions at the time of the trade.
So it's a way to track my progress and see what's working and what's not.
Exactly. It helps you identify patterns in your trading behavior, both good and bad.
Okay.
By reviewing your trading journal regularly, you can learn from your mistakes and improve your decision-making process over time.
It sounds like a really powerful tool for self-reflection and continuous improvement.
It is. It provides those valuable insights into your strengths and weaknesses as a trader, helping you refine your trading plan and your overall approach to the market.
I'm starting to see how all these elements, from risk tolerance to trading plans and journals, fit together to create this really robust risk management framework. It's not just about avoiding losses, it's about creating this disciplined and consistent approach to Forex trading.
That's right, and that disciplined and consistent approach is really essential for long-term success in the Forex market.
Well, this has been an incredibly insightful deep dive. We explored the power of VPA, the complexities of central bank intervention, the nuances of different currency pairs, and the critical importance of risk management.
Yeah.
I feel like I've gained a whole new understanding of the Forex market.
Me too.
I feel much more confident now about navigating this complex market. I'm ready to take what I've learned and start exploring further.
Awesome.
And for our listeners, I encourage you to keep exploring, keep learning, and keep diving deep into the fascinating world of Forex. Remember, knowledge is power, especially in this ever-changing market. Until next time.